And we're back. After that short little intermission that we had, we're right back with some more informal education. Now what we want to talk about is a wash sale. And what the wash sale rule is specifically. It is explained as followings. The wash sale is an IRS rule that prohibits a taxpayer from claiming a loss on the sale or trade of a stock, in this case a security, when an individual sells or trades that security at a loss and within 30 days before or after that buys the same or substantial type of stock or security or the same sector. Let me give you an example. Let's say you're in the airline sector and you take a loss in American Airlines. Well, what they like to do is claim that loss against their taxes at the end of the year. And so what has happened is that, let's say if you go back in from American Airlines, you go back in, you try to buy Boeing or you try to buy Spirit. Anything within that same sector will qualify under the wash rule. The wash rule also applies to traders the same way it applies to investors, but the difference is traders have a much harder time with record keeping because of the in and out every day with the trades of the transactions. This rule only applies to losses because naturally the IRS wants to tax your gains and the money that you have. Now, the wash sale rule sucks. But the reason that the IRS put this rule together is because investors do something called tax loss harvesting. And what tax loss harvesting is from an investor's portfolio, they look for stocks that are not doing well and are in the red, but they still like the stock for the long run. So what they do is they sell the stock, and by selling the stock, they bring down their taxable gains for that year, and then after December 1st, they go back and buy the stock again. So was this tax loss harvesting that investors were doing, which made them come up with the wash sale, saying that if you take a loss in this particular stock or any stock in this entire security, you have to wait 30 days before you can repurchase that same stock or any stock in that sector again. Now, as a day trader, we may buy and sell multiple positions in a stock in a single day. And if it's a hot stock or a sector, we may trade that stock every day for the whole week. Now, the IRS has established guidance specifically under tax topic 429, which clarifies what an active day trader is for tax purposes. So now we want to cover how to avoid the wash sale. There's several ways to avoid the wash sale. One of the ways I mentioned, and that is to simply wait 31 days. I said 30, let me be corrected. Wait 31 days before you repurchase that particular stock or a stock in that same industry or sector. The second way to avoid the wash sale rule is to elect mark to market on your accounting method. Now, mark to market method, it has the effect of eliminating wash sales and converting capital gains and capital losses into ordinary gains and ordinary losses. Example for illustration purposes. If you're under the wash sale, okay, and at the end of the year, let's say you have a capital loss of $10,000. Well, the IRS says you can only deduct $3,000 against other sources of income. So let's do the math. 10 minus that 3 leaves you 7. So you would then carry $7,000 into the next following tax year. Now, let's say at that year, end of that year, you have a capital gain of $7,000. What this would do is offset you because of the previously loss, and then the current year's gain would offset you. Now, but let's say you incur another capital loss on that second year. Let's say you lose 7 the first year and you lose 7 the second year. The IRS will still only allow you to deduct $3,000. This is if you're under the wash sale. Same scenario, but now we're going to show you the difference between being a mark-to-market trader. A mark-to-market trader at the end of the current year, let's say you lose 10 grand. Well, you can actually deduct the entire 10 grand against any other sources of income in full, which makes the benefit of mark-to-market is that losses are fully tax deductible. To make the mark-to-market election, a trader must attach an election statement with their tax returns notifying the IRS that they plan to become a Section 4745 mark-to-market trader for the next tax year. For example, 2021, when you file your taxes in April, this is when you would attach that statement with this year coming up, 2021. The following tax year in 2022, when you fill those out, you're going to attach a form 3115 documenting your change in accounting method, and this essentially completes your mark-to-market process. Now, please take a note. Day trader taxes can be extremely complex due to the ever-changing tax laws. Please speak to a licensed CPA who understands trader tax. Now, for my people, if you need the assistance, let me know. I have a specific trader tax CPA who is doing the same for me, putting me mark to market, and also going to house and protect myself by creating an LLC with an S corporation. Now, we'll go into that privately because, like I said previously, it depends upon where you begin at and where you want to start at in the market to determine how much protection you're going to need. Now, moving right along, we want to have a little recap. This is where we get a little interactive. And even you that's watching at home, you still should know these answers if you paid attention to the following courses. Number one, what is a stock? Anyone? Anyone? Bueller? Bueller? Does anyone remember what a stock is? Okay. Well, let's go to terminology. Okay. All right. A stock is a security, okay, that we buy that gives you a piece or share of a company. Right? Okay. That's what a stock is. Number two, what type of stocks are there? What type of stocks are there? Does anyone remember? Say it again.
Defensive stock.
Correct. Cyclical, correct. Defensive and cyclical stocks. Again, for a recap, defensive stocks are stocks that will continue to go up or at least sideways during economical times. These are stocks of companies that no matter what we're going through, you're going to buy. Toilet tissue, toothpaste, baby wipes, cat food, whatever these perishable items are that you have to have every day. Now, cyclical stocks are stocks that only do well in booming economic times. Buy a new car, take out a new home loan, go on a vacation, buy some jewelry. Anything that is done during economical times, because just the opposite, when times are hard, no one buys new cars, no one goes on trips, no one floods the airport, no one goes anywhere. So those are the two differences, defensive stocks and cyclical stocks. What is the difference between a day trader and an investor? Anyone? You too, camera woman. What is the difference between a day trader and an investor? A day trader buys and sells stocks in what?
Within the day.
Within a day. And an investor buys stocks and continues to buy and reinvest his dividends and reinvest more money to build a portfolio over a longer period of time. Okay. How much money should you start an account with?
Depends what you're trying to do.
Aha! But going back to what we learned in the class, how much?
I don't know.
The correct answer is all of the above. As much as you can. Remember, your stock trading account is like flying an airplane. The more altitude you have, the safer you are when things go wrong. If you only have an account, a couple thousand in it, it's like flying at treetop level. One mechanical mistake, you lunch meat. The higher the plane is, the more money you have, the more time you have to recuperate for if things go wrong. Remember that. Money is altitude. Get some, as much as you can. Now, next question. Should you open a margin account or a cash account?
Cash account.
Okay. Depends on what you're doing. Depends on what you're doing. Remember, if you open a cash account, you can only use the money that you have in there, which is good. If you open a margin account, sometimes margin accounts will give you leverage 2, 4, 6 times as much money as you have. That can only be good intraday. Overnight, you can incur interest. Overnight, you can incur losses. And if you incur a loss on money that's not yours, you're going to end up owing your broker. So, depends on what you're doing. If you need some advice, talk to me. Who is your broker and why? Well, some of you all might not know that because we didn't even go into that a little bit in depth. But I think I did as far as who I personally use. I personally use Trade Zero. I personally have quite a few brokers. I have international brokers. I have Trade Zero. I have TD Ameritrade. And I have a baby account, Robinhood. So those are our brokers. And your brokers is going to depend on what you want to do. If you want to be an investor, TD Ameritrade will work for you. E-Trade will work for you. Fidelity will work for you. If you want to be a day trader, you're going to need Interactive Brokers. You're going to need Trade Zero, or as I recommended, Cobra or Venom, depending upon the amount that you start with. What is the wash rule? How to avoid it? Does anyone remember what the wash rule is? The wash rule is a rule that prevents you from claiming a loss on a stock that you got out of, and within 30 days you buy that stock again. In order to avoid it, you either have to wait 31 days before you repurchase it or elect mark to market with your tax returns and send that in to let the IRS know that you are an active trader.